Good afternoon for those of you who are joining us today. This is Tom Abrassart. We're going to be talking about the Tax Cuts and Jobs Act passed right at the end of 2017. The law is very much in the making, so there's a lot of uncertainty. We're going to talk about that. Our goal today is just to give you the basics of the law. We may get into the weeds a little bit, but we want to pass along some ideas on how you can plan for it and make the best use of the tax cuts that are there. So today is sponsored by the Medical Office Resources of Florida, a group of like-minded colleagues that serve the medical community and small businesses. You'll see a couple of links there. The first is to the MoreOff website that has a wealth of resources of various kinds, upcoming meetings and the like that you might find useful for your own small business. And the second link is to YouTube. So there are hundreds, literally, of recorded training sessions reaching back several years that cover a multitude of topics that are of interest to small business owners. For example, we did a session on physician burnout, and we have an upcoming session on the same thing. We've done sessions on internal accounting control and a variety of any other things. Any other topics you want to highlight, Tim, that we may have covered with more?
I think the one that we did recently was well received was the succession planning and how to help plan for the owners of the businesses to leave their business. I think that was very well received as well.
Yeah, and the point being that we want to collaborate together so that all of you that have small businesses can begin with the end in mind, and so that you can build a practice that supports your life instead of sucking the life out of you. And that's part of the reason we're doing this today as well. So I'll start by introducing myself. I'm Tom Abrassart. I own a company called Longwood CPA that I started back in '86. We have a product in our office called the Back Office Support System, which is a comprehensive solution to maintain your QuickBooks accounting records accurately, to handle your tax returns, your payroll, and all that sort of thing. And the point is so that we can be advisors to you, again, building a business that's going to support the life you want to lead. I am a CPA, a certified financial planner, chartered global management accountant. I've been doing this for 37 years. And with that, I will hand the baton to Tim.
Thanks, Tom. And I can say that you do it very well to help the business owners keep balance in their life as it relates to their workplace, their family, and to have some time off. My name is Tim Caldwell. My firm, Pension Investors Corporation of Orlando, is located in Altamont. We're a third-party administrative firm that helps design and administer all types of qualified retirement plans. My background is in accounting, so I work with a lot of accountants. Graduated from the University of Central Florida, go Knights, as well as I've lived in Central Florida for the last 50 years of my life, married to Brenda. I really enjoy the aspects of doing qualified plan design because every situation is unique and everyone is different. And it's not just one size fits all. So I hope that as we go through this and cover a lot of tax code, you'll understand that it is complex. There's a process that we have to go through in order to be successful in designing the right plan and not just try to have a boilerplate concept. As we go through the presentation this afternoon, there's areas there where you can, there's a Q&A on the bottom that you'll see on your screen, or you can raise your hand. And if you have a question, we'll try to address it either during the webinar or at the very end. So Tom, let's go after it.
Yes, I'm going to back up just a little bit. If you do have questions, yes, do use that Q&A button at the bottom to post questions. We've got Janelle and Patty Hudson in my office assisting with answering questions, and Nancy Alvarez at Pension Investments is assisting Tim to answer questions. You can also reach me at tom@longwoodcpa.com, or you can email tim.caldwell@picorl.com with any questions we might not answer today. So with that, we'll dive in. So the first thing I want to say is This is the most significant tax legislation since 1986. There's over 1,000 pages here. And when the 86 Tax Reform Act passed, it took a couple of years for even the practitioners to fully digest what it meant. And we'll find the same thing with this tax act. It's a large and complex act. It's effective now. Many of these changes are temporary, so they're going to sunset after 2025. So like McDonald's McRib, it's only around for a short period of time. As we go through it, you'll see there are a lot of gray areas that haven't been spelled out. It's going to take the IRS a long period of time to write the regulations. There probably will be a Technical Corrections Act where they clean up some things that were overlooked in the legislation. And there's probably going to be a patchwork of implementation of this law, state by state by state, as they determine which parts of the federal law they're going to adopt and where they won't. So it'll be a patchwork quilt. These are the basic changes for the individuals. We're going to blow through the changes for individuals and corporations very, very quickly, because our focus is going to be on the 20% deduction for small business owners. And yet, I want you to have a grip on these major changes. Now, the first one is they've kept the tax brackets for qualified dividends and capital gains. So some taxpayers will pay 0% on taxable gains, some will pay 15%, some will pay 20%. And if you're a higher income taxpayer and you're subject to the net investment income tax, you'll be paying 23.8% on your capital gains. As most of you know, they've lowered the marginal tax brackets, so there's some savings there. They did repeal personal exemptions. We used to get 4,000 plus for each dependent as a subtraction from our taxable income. That's been repealed. But it's been replaced by two other things to help in that regard. The first is we have a higher child tax credit. So same rules as who applies for the child tax credits, $2,000 each, and $1,400 of it is refundable. They also dropped in a new $500 non-child dependent credit. So that might be for an elderly parent or the like. And those helps offset the loss of the personal exemptions. The second thing is the much higher standard deduction. So that's $12,000 for single people, $18,000 for head of household, and $24,000 for married filing jointly. So what we're going to find is probably somewhere in the range of 30% of the people in the country are going to be itemizing, and there'll be a much, much higher percentage of people that will not be filling out Schedule A to itemized deductions for real estate taxes, mortgage insurance, contributions, and the like. They did not repeal the alternative minimum tax. That's what AMT stands for. But the exemptions have increased, and again, fewer people are going to be subject to the alternative minimum tax. And all those things are good. It's going in the right direction. All right. This, if you just think in your mind what your taxable income was last year, that'd be page 2, somewhere around the middle of the page. Your taxable income, you'll get a sense of where you're going to fall this year. I want to point out that in the first 5 brackets, all the way up to 32%, there's no marriage penalty anymore. So it doesn't matter if you're married filing singly or separately or filing jointly, up to 32%. When you get into the 35% bracket, higher income taxpayers, there's going to be a heck of a marriage penalty there. These are the changes in the itemized deductions. They repealed the overall limitation on itemized deductions. So it used to be higher income taxpayers, they would phase out some of their itemized deductions as their income went up. So that's been repealed. Medical expenses, if you get over 7.5% of your adjusted gross income, you'll get some tax benefit and that itemized deduction for medical expenses. But that's just for 2017 and 2018. Starting in 2019, it's going to go back to that 10% level. All right, mortgage interest, they changed the rules so that, and we're talking about new debt after December 15, 2017. So a mortgage after that date, you can only deduct the interest on the first $750,000. On the old debt, the existing debt, we were able to claim interest on the first $1 million. And that debt is grandfathered, so it's not affected by this. If you have one of those old grandfathered mortgages that's more than $750,000 and you do refinance it, as long as you don't take extra money out of on that loan, it will qualify to be deductible. And even if you do take out mortgage equity debt, no matter what they call it, refinance loan or as part of a new home equity loan, if it goes back into building or improving your home, it's deductible. So 2 rules. New debt after December 2017, above $750,000, not deductible. Home equity debt, that where you take money out to pay off credit card bills and the like, that's no longer deductible at all. If you do take out new debt and don't go over the 750 limit, no matter what they call it, if you plow it back into your home, that's going to be qualified residence interest deductible up to $750,000.
Hey, Tom, many people have those HELOCs, those home equity loans, and they did them way back, and they used the money to build and improve their homes, and always took a deduction for that interest. You're saying those are grandfathered in?
I would say yes, they were. You bring up a good point, because I haven't seen specific regulations addressing old home equity debt, but I do believe it probably would. I'll say probably.
Yeah, it may be grandfathered in under that clause as long as it was used to build or improve, which might be hard to determine. But then going forward, if someone is going out there today or wanting to put in an addition to their home, you're saying that that's still going to be able to be done as long as it stays below that limit?
As long as it stays below the $750,000 of debt, yes.
Okay, good.
And again, you bring up a good point. These are the type of nuances that can only be addressed in the regulations. And we're going to be seeing, we'll be a lot smarter at the end of this year, all of us, you as clients and we as practitioners. We'll have software to deal with a lot of these things that we can assist you with tax planning once we see the finer details. So I always say that tax planning is a little bit like playing cards. You have to get all your cards in your hand and fan them out and see what you have. So in particular situations, no matter what the nuances are, we're going to be able to figure out what the best thing for you to do is. And I would also say it's going to be well worth it to you to pay your trusted advisors, your CPA or your other advisors, to do some planning ahead of time. We're going to hit that again later in this presentation, because if you invest a couple $1,000s in planning and it saves you $10,000 or $20,000, you'll have a good cost benefit there.
Yep, good point.
All right, so moving on, they limited the state and local tax deduction to $10,000 or $5,000 if you're married filing separately or you're single. So that's your state income taxes, it's your real estate taxes, it's your other local taxes. It's limited to $10,000. This will only come into play if you're itemizing in the first place. So if you're below the standard deduction, this won't affect you at all. Next item, charitable contributions. They increased it. You can take a charitable deduction for up to 60% of your adjusted gross income. So if you're a very charitably minded individual, that may be important to you. And then the last thing here is, at the bottom of your itemized deduction schedule, there were a variety of deductions that are no longer deductible. Job hunting expenses, moving expenses, as we'll see, are no longer deductible. Tax return preparation fees, investment management fees, all that stuff, that's all been repealed and hopefully replaced by the higher standard deduction. We're going to segue just for a brief minute on estate and gift taxes. They very significantly changed these rules by doubling the exemption from the estate tax. So a single person can pass along $11.2 million with no estate tax, and married couples can pass along $22.4 million as long as they take advantage of what's called portability. In 2018, you can gift up to $15,000 and not pay any gift tax. So you can give a gift to every person you know, friends, family, and as long as it doesn't exceed $15,000, you don't have to file a gift tax return. There's no gift tax consequences. The real reason for this slide is all of you should be working with a qualified estate planning attorney to have good quality documents. You don't want to leave your family in a mess. You need a good will, a durable power of attorney, especially with medical surrogate provisions after the Terry Schiavo case, and the use of trusts. These tools can increase your privacy. They can enhance your asset protection. Any thought on that, Tim?
Yeah, I think that's a great point, because these limits are temporary, right? They're going to revert back after some period of time, like they've done in the past. And even the comment about your trust, your medical surrogates and your basic will is not going to cover some cases. Trust documents can be updated. They're not permanent unless they're irrevocable. But even if they're irrevocable, with a good qualified attorney, you can make things work as family situations change and as kids grow, as businesses are started and closed. It's an ongoing revision. It's something that you just don't put in a safety deposit box and forget about it. You have to stay on top of it. So I think it's a good point. It's
a really good point, because documents that are not maintained actually make the mess worse than it was to begin with.
Yeah.
You made a very good point about the 2025. Things may revert back. My personal opinion is they will probably revert back on a lot of things. And so the estate planning attorneys are discussing now that if they're drafting now, they're going to say, if this happens, do this. If it goes back the way it was, do this. So there probably is a strong need to update our documents.
Yeah. As people are living longer, everyone's life expectancy is out there, and people are living well into their 90s and some into their hundreds. And dealing with one right now that the grantor of the trust that wrote it with her husband, he passed away in 2004, and she's still alive, and she's over 100 years old. So there's things that have changed now that their adult children are close to 60 years old.
Yeah.
And then with today's society, you've got your point there about asset protection. And not only will we see that there's some ways that you can write in to trust, but then when we start talking a little bit about qualified retirement plans, that's one of the main benefits of implementing one of those. So good.
There we go. Okay. So a couple other changes to note to casualty losses. If your home burns down now, it's not deductible unless it's in a federally declared disaster area. So we used to have casualty losses for various things. If those occur and it's not in a federally declared disaster area, it's not deductible anymore. So there's more need than ever to have the appropriate insurance on your properties to protect you. Next one, alimony. We can no longer deduct alimony. That's for new divorce decrees after December 31st of 2018, so after this year. So the attorneys and clients have the rest of this year to complete their divorce proceedings, still be able to deduct alimony. Starting 1/1/2019, alimony is not deductible, so that's going to significantly change the way that divorce decrees are settled and drafted. Moving expenses are no longer deductible. And there's changes in the kitty tax area. We used to want to transfer investment assets to our children to get some of the tax out of our own returns. But now, under the new law, when the child's income gets up to $12,500, this kind of passive income, it's going to be taxed at 37%. And we're going to touch on these business changes before we hop into the main reason for the call, which is the 20% deduction for pass-through income for small businesses. For the regular corporations called C corporations, they lowered the rate to a flat 21%. So it's a huge tax cut. Most of the tax savings in the entire act went to C corporations. This is effective after December 31st, 2017, so it's in play now. They did repeal the alternative minimum tax for C corporations. So that is not scheduled to sunset, but that's as permanent as a tax law change can be because Congress can always change the law. With respect to all taxpayers, C corporations, sole proprietors, S corporations, there used to be a domestic production activities deduction where if you had a hand in producing tangible property in the US, you got a handsome deduction on your tax return. That's been repealed. And we want to point out that business entertainment expenses are not deductible anymore. Meal expenses are deductible. So you can take somebody out for a business meal and still deduct 50% of that. But entertainment expenses, not deductible. Skyboxes, basketball games, stuff like that, no longer deductible. Accelerating deductions. So one of the ways you can reduce your taxable income is by taking fast write-off on property, plant, equipment, and real estate, rental real estate, or real estate used in a trade or business. And they very significantly expanded the deductions that are available. There's 100% bonus depreciation for qualifying property after December 2017. So that particular one was actually backdated. Many of these enhanced provisions used to only be available for new property. Now they're available for new and used property. And they've expanded the definitions of qualified improvement property. They've increased the Section 179 write-off to $1 million. They've expanded the definitions for what can be written off rapidly, such as roofs and HVACs. And significantly, it's now, many of these benefits are allowable for residential rental properties where they weren't before. So the point of all this is there is much faster write-off available that can lower your taxable income. And that may work against you, as I'm going to talk about in just a moment. So this was one of the things that motivated me and Tim to want to talk to you today. There's a 20% pass-through deduction under the new Code Section 199A. And that's 20% of your qualified business income, called QBI. So your qualified business income can come from an S corporation. It might be a limited liability company that's being taxed either as an S corporation, a partnership, or a sole proprietorship. It applies to sole proprietors, and it even applies to trusts. And what qualified trade or business income is, I'm going to segue for a minute. Specified service businesses that involve performing services, they get phased out of this deduction. We'll cover the definition of qualified business income in a minute, but I wanted to highlight the phase out. This is the most important thing that I wanted the people on our call today to pay attention to. Your qualified trade or business income does not include your investment income. And it doesn't include your compensation paid as an S corporation shareholder or guaranteed payments as a partner. It's not that you add that back to your qualified business income. Congress is just saying you don't get to exclude 20% of your wages, your guaranteed payments. So the qualified business income is, think of it in terms of the net income after all salaries, including your own salary. It's the amount that many people in an S corporation or partnership will see on their K-1 form. Anything about that, Tim?
Yeah, I'd like to just emphasize the part that we've bolded out there about reasonable compensation. Many of the businesses that are in Central Florida that we're working with are probably the S corps, and they have a salary and W-2 wages that are being paid, and the rest is being passed through, usually on a K-1. That you can only use certain types of income for qualified retirement plans. But more important than that is you have a lot of auditors that come in and want to look at what the business owner is paying themselves in the form of reasonable comp. And without getting into too much details, if you're found that you are not satisfying their definition, and I like that your conservative number is about 42%, if they're not following that, there's extremely onerous penalties for putting that in place. And not only does it not work when you're trying to do a qualified plan design, it doesn't work when you're trying to run a business and get a surprise tax bill. So I would really strongly recommend that whoever's determining what that is, that it's run by your CPA, your accountant, your EA, whoever is looking at that, so that you can fall within the right guidelines.
So I want to make a comment about that, because if you're putting 2 and 2 together, the less you pay yourself in wages, the bigger your pass-through is going to be, which means the bigger your 20% will be. But the IRS is wise to this, and they've already said that they are going to pay attention to unreasonably low compensation. So what is reasonable compensation? I'm just going to cover some broad guidelines. I think generally you should consider reasonable compensation what you would have to pay somebody else to do what it is that you want to do, or what it is that you do in your business. And if you're thinking in terms of who you're going to hire for a given position, you're looking at their level of expertise, their ability to bring business into your business. All those things go into reasonable compensation. The University of Washington Law School did a study nationwide, and they found that on average, S corporations were paying out roughly 42% of their income as W-2 income to the shareholder owner. So that 42% is a good guideline as a starting point. And then you just back up and say, is that reasonable with respect to what I'd have to pay somebody to do all the things that I'm doing in that business? And as Tim pointed out, we want the compensation may need to be at a certain level to drive the ability to take additional pension contributions. So these things are going in different directions. There may be a need to pay more compensation to get a higher pension. The more compensation we pay, the lower the pass-through income goes down, and the lower the 20% deduction goes down. So that's why we have to spreadsheet some of these things.
Yeah.
Anything else on that, Tim?
Yeah. Nope. And I think it all, when it comes down to small businesses, it's cash flow is king. And so we have to balance out what we need in the business to be running the business, as well as what we need for our lifestyle that we would pay out in the form of wages. And then whatever's passed through, whatever's there, it becomes more of a discretionary number. Whatever the goals are, we have to try to make those goals fit the solutions. So let's go.
Yeah, so good tax planning you can work with your practitioners to, as Tim said, to have the money you need to live, be maximizing your retirement and minimizing your tax all in one go. All right, so what is a specified service business? These are the guys that get phased out once their income gets above $315,000 taxable income. And it's a specified service business is probably most of the people on this call. Any trade or business involving the performance in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, in any trade or business where the principal asset is the reputation or skill of one or more of its employees, or that involves the performance of service that consists of investing, investment management, trading, dealing in securities, partnership interests, or commodities. So if it walks like a duck and quacks like a duck, it's probably a service business. And we'll expect to see additional regulations here as well, defining what these are. Now, the law did exclude engineers and architects from being service businesses, where previously they had been included. So we know that those groups had a good lobby. And in this table, it gives you some of the basics. If you are a service-based business and your taxable income is less than $315,000, you get a 20% deduction. Now, it's important that it's taxable income after you take out your capital gains. I want you to remember that. If you're a non-service-based business and your income is below $315,000, again, we're talking married filing joint, it would be half that for single people. You get a 20% deduction. So that first tier is easy. What we're going to talk about in our succeeding slides are the second and the third tiers. In the second tier, if you're a service-based business and you're between $315,000 and $415,000 of taxable income after you take out your capital gains, you lose the ability to claim this 20% deduction. So if you're halfway through that phase-out range, let's say your income is at $365,000, you lose half of your 20% deduction. So it's pro rata, it gets phased out between 315 and 415. I've heard different commentators make different statements about the wage capital tests or the wage basis tests, which we're going to discuss in a minute. But once you get above $315,000, you may have to overcome another hurdle. So it's limited based upon how much wages you pay and how much you have invested in property, plant, and equipment. We'll get to that in a minute. And then the third one, if you're over $415,000 and you're in a service-based business, you're just not going to get any deduction, period, unless Tim and your other trusted advisors have some arrows in their quiver to get you below 415. If you're in a non-service-based business, when you're above 415, you're not facing that phase out, but you do have the W-2 and basis limits we're going to cover in a minute. So what are the limitations on that 20% deduction? As we just said, it's different if you're a service business versus a non-service business. So the service businesses, you get phased out starting at 157.5 if you're single, or 315,000 married filing joint, and you're fully phased out when your taxable income hits 207.5 as a single person, or $415,000 married filing joint. The deduction, the QBI deduction, is the lesser of 20% of your qualified business income, or 20% of your taxable income minus capital gain. So that's a hurdle as well. So if you have significant deductions on page 1 of your return, your taxable income may actually be lower, and you may not get the full benefit of your 20% of your qualified business income, which means that from a tax planning standpoint, all the elements that make up your taxable income on page 1 of the return are in play for us to manipulate to maximize this 20% write-off. Where the taxpayer has a service business and their taxable income is below this threshold, their deduction is the lesser of 20% of QBI or 20% of taxable income. I'm just restating what I just said. And where the taxpayer has a specified service business and the 1040 taxable income is more than $415,000, there's no deduction at all. So once we get above that $315,000 hurdle, these additional hurdles may come into play. The deduction is further limited to 50% of W-2 wages, or 25% of W-2 wages plus 2.5% of the unadjusted basis of your property, of all your qualified property. So first you do the 20% of QBI, you do the 20% of taxable income. Now you're doing 2 other calculations. In these last 2 calculations, the deduction is the greater of 50% of W-2 wages or 25% of W-2 wages, 2.5% of the property. If we're thinking in terms of the real estate trades or businesses, they have substantial monies invested in rental real estate and the like. And this is the unadjusted basis before depreciation. So there's more math to run there too.
Yeah, that's what's so tricky about this, Tom, is that when I look at that slide and I see all the different tests that you have to go through, it would be crazy to try to weight until after the tax year is over and hope that everything lined up, because there's too many moving parts going forward in this law that could significantly affect whether or not you're going to put something as a line item on page 1, or you're not, or you're going to include it as comp, or you're not. And what's more important, to take the deduction or to forego maybe to be within that threshold. So I'd say there's a lot of planning that's going to come into play during 2018, so that people won't be surprised and go, wow, I wish I would have done that earlier. I wish I would have gotten with someone to at least run some anticipated numbers based on what they did last year within the threshold of the new tax law.
You're right. Virtually every single line on page 1 of your tax return, all your elements of income, gain, and loss, you can control those to a certain extent, because most of us, virtually all of us, are cash basis taxpayers.
Yep.
So we can control the amounts of any of those amounts. And that means that we can either maximize or not maximize this deduction intentionally. The whole point being, we want to be intentional and plan ahead, like you just said.
And I bet you there's some ways that you can do that temporarily, or some, maybe even some more permanent ways. Oh, yeah, like this.
In this slide, we're going to talk about if you're above the $315,000 threshold, and especially if you're above the $415,000 threshold, you're not getting any deduction at all. What can you do to fix that? My first bullet point is, don't do anything irrevocable yet. We want you to start planning right away, because you can see that there's a lot involved. But until we have some more guidance from the IRS, we don't want people, for example, spinning off parts of their businesses out into other businesses thinking it's going to help them. So don't do anything irrevocable until you're working with your trusted advisors. We want you to remember that the 20% deduction is the lesser of 20% of qualified business income, or 20% of taxable income minus capital gains. So we're gonna focus on reducing our taxable income without reducing the pass-through.
Yep.
So, you have a comment?
No, that was just a good point. And sometimes it's the fact that I need to have as much monies for retirement as I possibly can, and I just have to take that because it's a good use of money.
Exactly. We're gonna cover that in the next few slides.
Yep.
The service businesses above $415,000 are actually paying tax on more than $160,000 on their last $100,000 of incremental income, because they lost that 20% deduction. So that's somewhere around $20,000 of tax. So if you're in that range and you're not paying a couple of grand to get the right planning done, you are just shooting yourself in the foot. Now, what are the potential strategies? There's temporary and there's more permanent ones. A temporary strategy, because you're a cash basis taxpayer at the end of 2018, you thought, oh, I'm going to be over 315,000 this year. I'll just go to Aruba for the last 2 months of the year and lower your income that way. Or maybe you'll defer income by not collecting receivables in December, not collecting it till January. Or maybe you're lowering your income by accelerating your deductions, like taking more bonus depreciation in Section 179. That's going to lower your taxable income this year, but next year it kind of come back to bite you, and you have higher income in future years. So it's a temporary solution, as is depreciation, like I'm noting in that second bullet point. Now, more permanent solutions would be if you happen to be charitably minded, and if you would be making charitable contributions anyway, you can effectively bunch your deductions by dropping that money into a donor advised fund and taking a big write-off in the first year. So that may help you get below 315. Of course, if you don't have any deductions at all, you get a $24,000 standard deduction if you're married filing joint, so that may not be the most efficient. You can also shift some of your investments into tax-exempt investments. So you would continue to get the cash inflows from investments, but it wouldn't be taxable, would help lower you to get below 315. Some commentators suggest the use of oil and gas investments, highly tax advantaged. Some of these are put together by charlatans. Others are well-crafted and good business deals. They can offer very, very large upfront deductions from depletion, and that can help get you below 315. The next one I alluded to a little bit earlier. I don't want you to do anything irrevocable yet, but let's use the example of an optometrist that does eye exams in part of his practice, but most of the profits come from the eyeglass sales. And right now the practitioner has those both in the same business. If they spin off the tangible property piece, the eyeglass sales, that business is going to be a non-service-based business. It's not going to face the same kind of deduction limitations that we have for service-based businesses. Or there might be, you might be selling orthotics, you might have a cath lab. So some businesses already now are looking in terms of spinning off, breaking their businesses apart to have a piece that's not service-based business, create a whole another level of tests and increase the deduction that way. I asked Tim Caldwell to come on this call because I personally believe one of the most powerful ways to do this is with qualified retirement planning. And again, we're focusing on deferrals first, but then if we can't get there with just our 401k deferral, we're going to want other business deductions. And qualified retirement planning can drive that deduction and at the same time leave you with the amount of money that you need to run your life on a month-to-month basis and meet your budgetary needs. So it doesn't have to be all in, zero out your taxable income, because that's the best tax-wise. You're going to make a trade-off between money you need in your pocket now and money you can sock away. And Tim, if you would cover that in this next slide.
Yeah, I would agree that there's so many different ways in which you can design a qualified retirement plan. And it can start off as simple as a 401k plan that allows someone to deduct on a voluntary basis monies from their paycheck and stash it away. And I think the most successful plans are the ones that are started early and that you're educating the employees to understand that it's not about where you invest the monies, it's the fact that you're getting started sooner. And so many employers are looking at it from the perspective of how do I get the largest deductible contribution? That's our society, and that's how this S Corp owners are geared, and they're working and they're entrepreneurial minded. So we have to sit back and design a plan in such a way that based on someone's age and how many years they have till retirement, how does this work best for the person who owns the business? In doing that, we're able to then specify and put people in different classes so that you're allowed to have different contribution levels for different employee groups. All that being said means that there's a lot of flexibility in how you can design these plans. It's not a one size fits all, like I was saying earlier. And it's also not just to get a big deduction in this year. Qualified retirement plans are set up for permanency. The IRS has specific guidelines, and they want you to set it up so that you're providing these retirement benefits, because remember, we're getting a complete tax deduction from the business owner's perspective. And in doing so, the rule of thumb, when we look at any type of qualified plan, and especially if we get into the defined benefit plan and the cash balance plans, that we want that plan to be out there for a minimum of 3 years. It also, coincidentally, that's what you can use as a vesting schedule on a cash balance plan, so that people are going to stick around and they are going to be profitable employees, meaning that they're helping us make money. So the employer does not mind spending the money on the employees, because they would much rather give those dollars to their employees and say, thank you for helping us be profitable. Thank you for spending your time here. I would much rather give it to you than to write a check to the U.S. Treasury. So in doing plan design, especially with a cash balance plan, and if there's any advisors that are listening and the accountants, we've got to make sure that in doing so, that it's a very conservative portfolio investment. It's not something that you self-direct like you would on a 401k plan. And those monies are there for pension and retirement funding. one of the examples that we, no, that was good. One of these, that's perfect. One of the examples that we generally have smaller employer, somewhere between sometimes one, two employees, maybe 5. In this illustration, we showed a 401k plan with a safe harbor feature, which gives everyone a minimum of 3 to 5%. And then we built on a cash balance plan. And we did not maximize this particular scenario because, as you'll see in some of the following slides that Tom did, we didn't need to maximize it. Can we go higher? Yes, we can. Can we give individual contributions to certain people that are in my employee workforce? Yes, we can. But in this particular scenario, we needed to spend about $100,000 out of the business, not to include the $24,000 that he was already funding for his salary deferral. So in this particular scenario, the $200,000 was the optimum compensation that we needed to take for that, for Dr. Smith's lifestyle. And then as we looked through and looked at the pass-through income that was coming in there, we only needed to use up this certain portion of it. So we didn't have to maximize, and probably could have put in twice as much as what's underneath that cash balance. The good point about how these are designed is you can see that there's a go back one, Tom, that there's a pretty big difference between what the doctor can get in the cash balance and what the employees are receiving as a benefit. And the IRS has a guideline that says that the employees must receive a meaningful benefit equivalent to a certain percentage of their compensation in their monthly average compensation. So we are able to move that number. Sometimes it could be 550, 750, 1,200, 3,000, whatever the goal is for the owner in order to do that. But remember, this entire contribution that's going in there for that $10,900 for those employees is tax deductible. And so there's a savings to the employer for the cost of those employees that are in his plan. Just wanted to point that out. Tom, you got anything?
No, we'll move on. We're going to get a little bit into the weeds in this example, but we hope it's a practical example.
Yeah, can you
strikes a balance?
Yeah, go ahead and walk through that so we can show that on the with and the without.
So we're assuming here that the practitioner had $463,000 of income before paying himself wages. And he pays himself $200,000 wages, thinks that's reasonable compensation. And his practice net income is $263,000. So that's what's going on at the entity level. $200,000 of wages and $263,000 coming through on a K1. So if you drop down and look what happens at the personal tax return level, he still got the $200,000 of wages, but he had the $24,000 401k deferral. So his taxable wages are $176,000. His pass-through is $263,000, as we said. And I just kept this really simple to make a point. His standard deduction is $24,000, assuming they're married, no other income. So his taxable income is $415,000. And he's a service-based business. He's a doctor, so he's above the phase-out range. He's not going to get any deduction at all. Now, if you compare that, what happens if you put in a pension solution, again, on the right-hand column, we start with $463,000 of income, and we drop in $200,000 of wages, and we have $20,700 of profit sharing, and $79,300 in the cash balance plan. Now the practice K1 pass-through is $163. So that comes from this example we were pointing out here. So here's the contributions that we're talking about.
Yep.
And the deferral for the doctor. Pardon my scratch. I'm there. Working on changing slides here.
And see, and a lot of people don't realize, Tom, when you're doing that math, is that we're adding back these numbers to where they when they first heard this tax law, many people thought, oh, I can just take 20% of whatever that pass-through number is, and I can deduct the whole thing.
Yeah,
That's where the mistake was.
not true. All right, so this is the first time I've used this product, so bear with me. I can't delete my annotations, but let's continue in this right-hand column. So we got down to $163,000 of practice net income with the pension solution. So at the individual tax return level, this person has $200,000 of wages. They still have the $24,000 401k deferral. They're down to $176,000 of taxable wages. Now their pass-through income is $163,000. Bear with me. $163,000 pass-through, and still the same $24,000 standard deduction. Now they're at $315,000. Give me just a second. I'm going to see if I can delete this. There. That's a little better. All right. So in our example, without the solution, $415,000 of taxable income on the W-2, on the 1040, no deduction. We put in a pension solution, got them down to $315,000, and preserved the entire 20% deduction. Now we have to start applying our tests. So first we'll take 20% of the pass-through income. That number is $32,600. We have to compare that with 20% of taxable income because it's the lesser of the two. So 20% of taxable income is $63,000 with the pension solution. And their deduction, then they get the full 20% deduction. So their taxable income with the pension solution is down to $315,000. They get an extra $32,000 deduction. And their taxable income is down to $282,000 now. So if you compare that with what's on the left, taxable income without the pension solution, $415,000, and we compare that to with the solution, we're avoiding $132,000 of taxable income. And in the section below, I'm just showing my math on how the savings are calculated in each bracket. So if we work down this slide, we get down to here, we've saved $40,000 of taxes. We've avoided income of $132,000, so we're saving at the rate of roughly 30% on this $40,000.
Yeah, that's good math. And you know, in a lot of cases, Tom, when we're asked to look at this and do an analysis and find out what that number is, if we don't do compensation planning, if we don't know what cash is available to spend or what they need to live off of, it's meaningless. And so this exercise of being able to plug in different numbers will help us optimize not only what the code allows us to do, but if the person needed to fund a little bit more, they could. They can design the plan any way they want, depending upon what the practice owner is trying to accomplish.
So let me comment on this. I realize we're in the weeds for sure with a lot of detail, but look in this first column on the left. So we put in a cash balance plan. We had to contribute $8,700 for employees. Number one, that's going to make those employees more sticky because you're rewarding them. We put in the profit sharing piece for the practice owner, $12,000. We put in the cash balance plan, $79,300. So we're putting $91,300 in through the enhancement of the pension plan. And we already had the $24,000 deferral. So doctor is actually putting away $115,000. Because he saved $40,000 of tax, it's really only costing him $75,000.
Yeah.
You might say to Tim and I, well, that's all well and good, but I can't afford to do that. Tim's point is you don't have to go full bore to get all the way down to 315. You're going to strike a balance for what you want to do at home. So this section on the bottom is just an illustration of what the cash flow might look like for this doctor. They have $24,000 of wages. They have $24,000 of deferral, so they're not taking that home in their pay. If they distributed all their net income from their S corp, they could have another $163,000 of cash flow in their pocket. And then if we take away an estimate of their federal taxes and the FICA they pay on wages, they end up with almost $273,000 in cash. So in this example, doctor is socking away $115,000 every year for him or herself, and they have $22,000 plus a month to live on. So they have to look at their budget, decide what will work. And to Tim's point, the pension plan can hit anywhere in between, right, Tim?
Yep, exactly. And, you know, and everyone's different. I know that you're right. We've probably hurt people's brains with all the calculations, but that's done behind the scenes, and it's done after we've had some higher level discussions about what some of their goals are and what they want to accomplish with the plan. Because sometimes it is a certain group of people. Sometimes it's a dollar number that we're trying to sock away. Sometimes it's asset protection. Maybe it's an older business owner that's trying to get some of the equity out of their company and get it to a younger person in the business. So there's so many ways that we can make this work for a practice owner, but every one of them is different. So, you know, Tom and I can make ourselves available. If there's someone out there that has, you know, a specific scenario, we'd be glad to look at it and see if we can make something work for you.
So we're just going to wrap up for today. We're going to need more guidance. There's going to be a lot of gray areas in terms of what's qualified business income, which kind of businesses qualify. What is a trader business? For example, does a Schedule E rental qualify as a trader business, or do the passive activities rules knock out that 20% deduction for rental activities? I've heard it go both ways from commentators. There's going to be interplay with various other sections of the code that may make some of these pieces work or not work. The main thing we want you to remember is if you're above this phase out range, you need to do something in advance. Don't wait till the end of the year. And if you're not planning correctly and you get your taxable income too low, it's going to lower your 20% deduction. So different math goes in different directions. That's all we have for today. And, thank you for your time.
Yeah, as I just encourage you, if anyone has any questions, they can contact Tom or myself directly. We'll be glad to answer any questions. Thank you, Tom.